Everyone who's joined us today, welcome to the bizval webinar. I'm Graham Stephen, the co-founder and CEO of bizvalglobal.com. And, we're really passionate about empowering SMB owners to make better decisions around value creation. We work with lenders, M&A professionals, advisors, as well as business owners directly. So today we're delighted to be hosting this expert panel discussion on the state of SMB M&A in the US. Technology permitting, this all goes smoothly and everything's clear. But this comes off the back of our recently released report into M&A in the US. The report is available on our website for download. It's at www.bizvalglobal.com. And it draws on more than 2,000 data points, a number of expert interviews, survey data, and focuses on businesses in the sort of $1 million to $50 million range. So I'd just like to take a minute to acknowledge all the contributors to that report, some of them on our panel today and the others who are not able to join us. Really just want to appreciate all the input and insight into that report. Just some basic housekeeping today. The webinar format is a panel discussion. We hope to chat for about 40 to 45 minutes. There will be time for a few questions at the end, but please feel free as we go along to put some questions in the Q&A chat, and we can pick those up at the end. We have got a poll question running. That is, what is your biggest challenge in getting a deal over the line in today's M&A environment? So take a second to go and complete the poll. The webinar is being recorded and it will be available on our website and YouTube channel afterwards. So if there's a problem with your connection or anything like that, normally these recordings happen to the cloud and happen individually. So if you have an issue, go and check it out afterwards and the recording will be available. Without any further ado, I'd like to introduce my co-host and VP of bizval US, Kyle McCulloch, and he'll be introducing our guests.
Yeah, thanks, Graham. Great to be here. So I'd like to get straight into introducing our panelists. They're all experts in their respective fields and probably fairly well known to some of you already. So to begin with, we got Mike Finger. He's the founder of Oasis. Candice Bradley, who's the founder of Bradley and Company. Ryan Tansom, who's the creator of the Independence by Design framework. And then Luke Maupin, who's the SVP of Commercial Banking at Choice Bank.
Thanks, guys, for joining. And yeah, today's about you guys. You're the experts, we're just the facilitators. But before we get into the questions, I just want to kind of summarize some of the key themes. We're going to go into more detail just now, but there were sort of 5 key takeouts from the report. And, despite tighter credit, we're still seeing good demand for high quality SMBs. Deal momentum in the last quarter has been up somewhat. What the multiples and the valuations are showing is that there's a clear separation between quality assets and less well-prepared businesses. The finance landscape's evolving. There's ongoing and recent changes to the SBA environment. And I think, just to recap, operational maturity is definitely, playing a more important factor than the size of the business per se. So without any further ado, I'm going to start the conversation. And, I think the first question, let's start with Luke and Candice, is we've come off, a period of sustained high interest rates. And, this has led to elevated borrowing costs. So the question is, have we seen this impacting on deal appetite? And how have you guys seen this impacting on valuations within the SMB segment? Luke, I don't know if you want to kick off.
I'll jump into this one. Well, obviously, high rates are having a direct impact on dry powder that companies are going to have to put into acquisitions. It's impacting cash flow. There's a lot of other things going on, I think, that are impacting the banking environment. However, deals are still getting done, just more creatively, I'd say. And overall, the bank appetite is heightening every day. And I think, deals are still coming through as quickly as we can get them done.
Yeah. Candice, you're sitting a bit more with the legal hat on. What's your experience been?
Yeah, so I would echo what Luke mentioned. I think there's a segment of buyers and sellers that are also still very interested in transacting in the market and wanting to get deals done. I think they are definitely required to be a lot more creative in structuring, a lot more thoughtful in thinking about longer term plans and how to kind of incentivize both sides of the transaction to work together a little bit longer term. But certainly, there's still appetite to get deals done.
Yeah, I mean, what are some of those creative things we're seeing? I don't know if Luke, I mean, or Mike or Ryan want to jump in. Yeah, I mean, people are getting more creative. But is it a shift towards earnouts? What are we seeing?
Definitely some of that. From a banking perspective, we're seeing, private money come into play. We're seeing a lot more mezz partners involved in deals. Even large banks that typically, historically, wouldn't allow for a mezz partner to be involved in some deals I'm seeing that get done more often than not. Sellers are, seller notes are more common. Aside from the SBA that has limitations around that, conventional banking is opening more and more to creative ideas and structures. Banks are all ears at this point to get deals done.
Awesome.
Yeah, so maybe Mike and Ryan, this would be a good question for you, but I think there's a lot of common misconceptions about what drives business value with many of the small, medium-sized entrepreneurs. So how often do advisors really have to reset expectations, and what are sellers typically getting wrong about valuations?
Let me
You want to go first?
jump
Yeah, you
in
go first.
yeah, I'll jump in real quick. I think, and you guys know I'm a bit of a contrarian on this stuff. I think what owners get wrong is that they actually read and listen to most of the content in this space. This is a space defined by complexity, right? Technical expertise, all sorts of hoops to jump through. Those are things that are real, but most owners that fail to sell because of something simple, right? And so I think what owners have a tendency to get wrong is that they think it's a magic formula, when in fact it's simple answers to simple questions, right? Are your results desirable? Can a buyer duplicate your results? Can you document your results? All that other complexity comes after. And I think too often owners consume the content that we see in the space, assume there's some secret formula out there that's going to light their path forward, and find themselves stuck.
Yeah,
I can add and contribute to that. I agree about all the content stuff, 100%. And I'm also kind of a contrarian too, because I think we talk a lot about exits, where like a lot of the people that I work with want to be capital allocators. And the reason that PE and acquisition entrepreneurs are coming after privately held businesses is because they generate cash flow. So I think being stuck in the business is the reason that people want to sell. That's why I sold the family business. Had we focused on future cash flow and to be able to predict future cash flow, not gross profit, not net income, but cash in the checking account. Like if I'm banking with Choice, how much will be in my checking account in the end of 2026? And if I can predict that after taxes, working capital, and debt, not only do I enjoy it as an owner because I can decouple my time, but also I can get lending. I can reduce the risk of the BS earnouts and the escrow and all that other crap. So I think like the name of the game is predicting future cash, and everything else should back into that. And that kind of ties into deal structures and to like, I mean, yes, rates are going up, but if we can predict future cash, then we should be able to go to Luke and say, these are the terms that I want, Luke.
what do you have to say about that, Luke?
If you have cash, I'm ready.
Yeah, I guess that leads into a question for you, Luke. Is what you're saying, Ryan, and what you're saying, Mike, is it comes across as contrarian, but it's not. It's actually basics. It's about cash. It's about owner dependence. It's about have you got over dependence on your key customers? But we haven't even talked about macros and that in this space. But I want to ask you, Luke, how does this environment, impact on how the banks are thinking about SMB lending? They're still open for business. Are deals still happening? What are you guys seeing from a choice perspective, and I guess across the industry?
Love this question. And I'm going to actually take a step back. We're on the topic of cash, so it's a great time to jump into this because I think we need to talk the banking environment as a whole. And this one really hits close to home for me because I actually recently had to leave an institution that I was happily working for because essentially we ran out of funds to lend. And if you can imagine being in a banking role and having to tell that to the market or anybody that you work with, it's a difficult thing to come back from. So banks will always try their best not to verbally say that. Essentially, we can rewind to talk more about this to the bank run on SVB. Now, that by no means was the primary cause, the beginning of this shift, but it marked the beginning of deposits that were fleeing the banking system quickly. And if any bank saw, difference to this, basically no bank avoided the stress of this. This changed appetite, not necessarily policy or regulation. And I think banks are classically famous for just spoon feeding information that truly fits their agenda. I truly believe the only reason I was invited to be on this is because I will never sugarcoat or defend banks or the industry behind them. I believe in peeling back the Iron Curtain, trying to give business owners a glimpse into what banking truly is and let them make the decisions. Knowledge is power in this regard. But to get back to your question, I want to remind everyone that bank financial statements are public information. Uniform bank performance reports are something that were created for a reason. By no means is a loan to deposit ratio a good measure of a bank's risk position or liquidity position for that matter. However, I think it's a good starting point, and it's a great topic for this question. We saw deposits leaving the banking system immediately. Every bank on the block is looking for deposits. They're begging for them. So this is changing appetite. Are the banks open to lending? It's also causing bank consolidation, which can uproot bank strategy. I saw locally a full team get uprooted from a bank just because their bank was acquired, and the new bank no longer wanted to lend in that space. So my whole point with this is don't ever be afraid to ask your bank stupid questions. I truly believe that you should understand your bank's goals and what market they want to lend in. Understand their decisioning path to give you funds. Who's making those decisions? It's not just your banker. Try to get in the room with those individuals because deals are getting funded. There are banks with a strong appetite, but in the past year and a half, 2 years, it's been incredibly difficult to find those banks. As somebody who works for a bank, as a shareholder banks, it took me a reasonable amount of time in the last 2 years to find a bank that was creative minded, focused on people and clients first, and most importantly had cash to lend. And I say that because when we're talking about deal structures, maximizing leverage, that cash component is key. So to kind of bring it full circle to what Ryan said earlier, I think that's the biggest concern that you should have when searching for a good banking partner is making sure that they have the cash and the hold limit to support your growth.
Yeah, and I think, but just to loop back on that, I think there's a subtext to that as well, is that if you've got a quality business with quality cash flows and all those things in place, have the conversation with the bank. The macros almost matter less than how well prepared your business is, and we'll go into that a little bit later. I want to move the conversation on a little bit, and what's quite interesting is everyone looks at multiples. Multiples are an output on kind of values of what business are trading on. You guys are all quite contrarian, and it's not about multiples. It's about cash flow, and it's about growth and repeatability of those cash flows. But just to bring it to something that a lot of our audience might relate to is where do we think multiples are headed from a Main Street versus lower middle market deal perspective? So, if we look at, what our report kind of indicated is that there's sort of a narrowing of the bands. We're still seeing separation in terms of different industries and opportunities. But asking the question maybe to Candice and to Luke and Mike, what are you seeing in terms of multiples? Have you seen an acceleration? Are you seeing them pulling back? Are you seeing a narrowing? What's your on the ground experience?
Yeah, I think this is such an important topic, to your point, Graham, from the perspective of buyers are looking across different parts of the market, are you able to hear me?
Yeah, loud and clear.
I'm sorry. I was getting a fair bit of feedback, so I wanted to make sure you were able to hear me.
I am too, Candice. Just keep rolling with it.
Just keep going. Okay. So I think it's so interesting to think about where many buyers are looking specifically in the market. And for me, I've been working with a lot of clients who have been more in the kind of the lower middle market to very much true SMB space. So 5 million and lower type businesses. And to the point of being contrarian, I think we all want to have this, kind of step-by-step, kind of process of this is the industry, these are the cash flows, this is, how long the business has been around, here are the margins, and therefore, magically kind of compute a multiple. But what I'm seeing is that particularly in this lower space, a lot of buyers are looking for quality companies, as we've all kind of talked about, and those have ranged. And it's kind of more been based on, to the point about cash flow, right? It's more been based on that cash flow, that predictability, that the operational kind of mechanics and SOPs, if you will, behind those businesses, and the ability to kind of come in and transition. And so from that perspective, multiples haven't changed much, right, for a quality asset. Now, when you're looking more turnaround situations and kind of things of that nature, of course, you have a range of multiples. But for a quality asset, particularly today with so many people looking for quality assets, the multiples haven't, kind of dramatically changed.
Yeah. I mean, Mike and Ryan, your perspective.
I completely agree with Candice. And on my podcast, I do a quarterly economic and merger and acquisition update where we're talking about ranges of multiples and deal structures and a lot of the data from private equity. And I completely agree with Candice. And here, back to Mike's point, we end up, so no one hears from the person at the casino that lost a shitload of money. They all hear from the person that won. And so what ends up happening is we end up hearing from the one person that got the highest multiple because they had the best company. And then we talk about that one person, but that's the 10% or less. And the problem is that 85% of the marketplace, I've had 3,000 people go through my workshops, and 10 people can forecast out their cash flow. How are we supposed to lend against that? How is an investor supposed to get an internal rate of return? How is the owner supposed to have a peaceful mind when they can't predict their distributions after growth? And so I think all of this accumulates to the same issue, which is, the multiples could go up and down on the best, on the best person, but we're trying to talk to people that are running normal businesses that can't predict cash. And therefore you could get a 5 multiple, but you're going to get one of that multiple upfront in cash. You're going to seller finance the rest, and you might as well kept the damn company. So I think the whole problem is the ability to predict out cash, and the multiples that we hear are a proxy and a rule of thumb, to Mike's point, that become dysfunctional to what we're talking about, where we have to be able to predict cash, lend against that cash, take the free cash flow and distributions as the owner. And the lack of our ability to see that is more stress for the owner, less ability to get lending, less ability to get the cash up front. So all this stuff is tied together, I think.
Ryan, I love that, because what it speaks to is the problem with multiples. And the problem with multiples is how owners use them. They use them to answer the question, what's my business worth? And that's the wrong question. The question needs to be, what can my buyer afford to pay? And that's where the interest rate and all these other things come in. And so it's fascinating to look at the multiples, but what it needs to do is inspire a business owner to have empathy for their buyer and be able to translate the wrong question into the right one.
I agree, Mike. And the one thing that I think people like once we swallow the golf ball of reality of like all the stuff that keeps you up at night, you're not going to bamboozle a lender and a buyer to like taking on your pile of crap because you got them over one. Like all of the things that keep you up at night, which is the lack ability to predict your future cash flow, is the same reason you're not going to get more cash up front and the same reason you're not going to get the lending. So like, I don't think there is a way. There is no free lunch. Maybe in 2020 when there was $5 trillion of free cash, floating around in the system, handfuls of people got, a free lunch. But generally speaking, like kind of with health, you have to wake up, work out, eat well, and sleep well, and then you'll probably be fine. And it's the same stuff with business.
Definitely
I see
agree
there's
with
a comment that's come through, and to the point that you're making, Ryan and Mike, it says, owners will tell you their company is unique, and many are, and in the next breath they'll tell you they think they should be valued at the multiple because everyone else is at that multiple. So multiples, I think are dangerous. It's quite interesting because we operate in different markets, in the UK, in Europe, and in US. And the US is the one market where there's this fascination around the multiple. In other markets, we do see a lot more focus on cash and more of a sort of a private equity view on the world. And we've been trying to get this message across for a long time: is multiples can be dangerous. Use them as a sense check, but it's an outcome and not an input. Mike, I don't know if you've got a closing thought on that before we move on to the next question.
Yeah, never forget that a multiple implies you're multiplying something. And it's that something that we need to be paying attention to.
Yeah.
Yeah, that's perfectly said. Yeah, I mean, I think that's actually a good segue into the next question. So I think from everybody, and maybe Candice, we start with you, then go Ryan, Luke, and Mike. But can you share the top issue that you're seeing that's killing deals right now, whether it's poor financials, owner dependency, client concentration, cultural fit? Just curious what everyone's seeing out there.
Yeah, I had somewhat mentioned it in the last question, but I think the biggest thing is just really understanding the cash flow. And I think from a business owner perspective, and I've certainly been there in different parts of kind of small business ownership for myself as well, where you are so narrowly focused in the weeds, trying to make sure day to day is happening, payroll is happening, you're getting the supplies that you need, et cetera. You are so kind of narrowly focused in those weeds that it's hard to kind of take the time to pan up and really understand the point that we're all harping on, which is the cash flow and the cash conversion cycle, and how valuable of a business am I building? So I think that's one. But then two, kind of connected to that, part of what makes your business very valuable is the fact that you are not in the weeds and you are not in the day-to-day processes, and you are able to kind of put together, orchestrate a team that allows you to shine in a way that's more strategic, more sales oriented, et cetera. And so I think the combination of those two together are really very important. So obviously keeping an eye on the ball in the weeds, but also being able to pan up and be strategic so that someone else is able to come in and not necessarily buy a day-to-day job.
Yeah, totally agree. Maybe Luke, would you like to pick up next?
Yeah, I would love to jump into that. I would say poor financial statements quality is not necessarily the meaning there, but understanding of it. Just echoing some of these thoughts. I see deals all the time fall apart for this very reason. There's maybe an owner's own financials that are intertwined with the business, especially in the SMB space. You see a lot of that where there's not true separation, and there's just a lack of understanding. Not only of cash flow, but properly managed working capital, inventory. This is something that can't be faked. It will come out in due diligence. It will be, light will be shined on, on this heavily, and that's something that as a bank, we see quite often. I would say is the front runner for what derails deals the most for me.
Cool, Ryan, do you want to pick up?
Yeah, and Before I start, I want to just say that I think what's cool about Candice is she has run her own business too. And like, where my comments are going to come from is I lost $1 million in 2009 on $21 million in revenue on a 115 employee company. And Inc. 5000, best place to work. Yay. Who gives a crap? And like the reality is, people listening in, like I've been there, and what happens is you're just like, so what are the issues of why people aren't ready? Well, it's because I was juggling a $250,000 payroll, and if I didn't have the bank wire ready on Thursday night, Luke would come and shut me out. He wasn't my banker. I wish he would have been, but like that's the reality of it. And everything else is a byproduct or is a derivative of like, I have to hit payroll, I have to collect my receivables, I have to turn my inventory, and I have to pay my payables. And that becomes, and what's in my checking account. And so that's the reality. And what happens is I've labeled this the owner operator trap, where like I wanted to be the owner and the capital allocator in the boardroom, but I'm stuck in this job eating crap every day. And so like, yeah, I want clean financials and I want an ERP system. Name the thing that I want. But what I think happens is the same reason that we can't get good deal structures is because the owner can't predict the future cash to say, when can I put in the $300,000 ERP system? When can I afford the $80,000 recruiter for my CFO or my CEO? And how does that impact my annual K1 of 300 grand so I can pay my freaking bills after taxes, by the way, of which I can never predict? So like I call it the owner operator trap, where we're solving for revenue and our K1, and we're in this hamster wheel, and we can't predict distributions because we can't predict our cash flow. So I think that everything on this list is a byproduct derivative of juggling payroll, juggling receivables and inventory. And like the question that I always had when we had our business is like, where the hell do I start? Like, great. If I could sit in the room for a month and build my financials, Luke, that would be great. You know what I mean? So I think it's this whole like taking the ownership red pill, which if you're listening in, just thinking this way, I think is a start. So I don't know. I mean, it's all of it, but like, I think it's the trap that kind of was where everything starts from.
Cool. Mike, do you have anything to add?
Yeah, I'm gonna first of all compliment the answers and then suggest that we have to take one step back from them, because let me see if anyone on the panel has ever heard this. I'll get my business ready to sell when I'm ready to sell it. The reason that we're not ready for sale is that we wait to engage this topic. We wait and then we fail. If we start earlier, then we learn about the things that each of the others answered about. The problem is right now, most owners hear that stuff and it goes in one ear and out the other because to Ryan's point, I'm busy running my business. I'm doing the day-to-day. The reason that we're not ready for sale is because we wait too long. Stop waiting, start engaging this topic. I'm not saying go sell your business right now. I'm saying start learning about this so that this information that you're getting here impacts your decision-making incrementally over time. You change your business, you change your outcome.
Mike, I love this. And can I interject, Kyle? Because I want to know for the audience or the panel here is I agreed with you, Mike. And for 10 years, I had engineered 3 businesses that no one wanted to work for because I had the word exit in it. And I think, I go back to my own self, and it was, I had a $21 million business and I had no freaking idea what it was worth. And I knew I had no cash. So like, an advisor's gonna be like, hey, Ryan, you want to exit? I'm like, I'm trying to hit payroll, dude. And so like, there's this underlying fear of like, I'm not even close to retirement because I have no idea what this thing is worth. And I have no idea how to stop. So I think what's interesting is this false choice of I have to exit. Because like the reason the word people start when they want to exit is because of that word, in my opinion, and I'm a contrarian on this, is what if I wanted to get out of my job and keep my asset and run the company from the boardroom like the private equity firm? Is that an exit or is that not an exit? And so like if I'm trying to focus on creating free cash flow without my job, then technically I'm just a capital allocator. And so I think the word exit actually disproportionately impacts people's reason for not focusing on this until they're tired of their job and they have no energy or cash flow to spend another 5 years to do all the hard work and suck up all the cash to build the value that they want. So I think it becomes an energy issue And I think the word exit has some kind of play in that. And again, I'm curious on what everybody thinks about that.
Yeah, I think that's fair. I think that's a fair criticism of that term. I'm not a fan of it either, except that I can't come up with a better one. And so for me, that exit is the framing. The reality is ownability and sellability are the same thing, right? We know that secret. We know that if we build our business in a way that we could sell it tomorrow, we can choose to keep it forever, and it's fabulous. But it's getting into that mindset and that framing that allows us to ask those basic questions about the business, about what it's giving to us as an owner. Because again, ownability, sellability.
Yeah,
Candice, I mean, sorry, Kyle. I mean, I was going to ask Candice. I mean, you've also run, a couple of your own businesses. I mean, how do you respond to that?
Yeah, no, I was coming off mute, but I wanted to let Mike finish up. I think both Mike's and Ryan's comments are so relevant and so important. So from my perspective, I was in we'd grown our business from 0 to 10 million in 2 years. So it was a completely chaotic. It was very challenging, but so much fun. And then we found ourselves at a point where, again, because I also have an investment banking and private equity background. So we found ourselves, to Mike's point, kind of grooming, if you will, our business for an exit while we were growing. And it was like this plane in the air doing way too many things at one time. But all the while still, to Ryan's point, kind of having the week to week of how do we make payroll? Do we need to move funds around? Do we need to delay this order? Do we need to? So it was like having hands in so many hats, like all at the same time, that I did want to exit because I just thought, like it would be simpler, and that's just not the way running a business works. So we kind of had a hybrid approach, which I think is maybe somewhat relevant and interesting, of where we still talk to the bankers, because again, I have a PE and kind of investment banking background. So once we hit 5 million, we started to have conversations with, bankers/brokers. We had a pulse for valuation, but at the same time, we were also investing, to Ryan's point, in our systems and like adding a new tech-enabled kind of system to our platform to help us be a lot more operationally efficient, so that like if we wanted to pull the trigger, we could, but we didn't. And then it's interesting, another dynamic kind of came into play that I clearly wasn't expecting whatsoever, which was kind of macro environment and COVID and post-COVID world for the clients that we served. Was a lot more challenging than the pre-COVID world for the clients that we served. And so we ended up having to talk to the Lukes of the world for financing. And then it was, is this the right financing? Is this the one that puts us in a hole? Which it ultimately did. And so like so much experience there, but it's essentially, as a business owner, and every audience knows this, but as a business owner, you're essentially doing all of those things at the same time while wondering, do I take the exit? Do I stay? Can I have a cash cow? Like, I'd love a cash cow and just not have a job. Or do you take the pot of gold, right? Like it's a very interesting mental dynamic.
Yeah, I think one of the other things, there's a good lesson that I learned early on when I was swimming, as my coach said, the best people get ahead by doing the boring stuff really, really well and focusing on the boring stuff. And I think as a business owner, there's a lot of applicability to that as well. I mean, you focused on payroll, you focused on client acquisition, but you just kind of look at hiring a bookkeeper, maybe like Auntie Jean or something like that, who may not actually be a quality bookkeeper. But when you get to the point where you have to sell, and you've been relying on someone who may not have the skill set, it's going to set you up for success, it's going to implode. So I think focusing on those really boring things, making sure that they're done right, will also lead you to successful exit. And I think just on the back of that, maybe Mike and Ryan, if you're advising a client who wanted to exit in maybe 2 to 3 years, like how should they start preparing? And is 2 to 3 years enough time? I mean, I know obviously we want to say, build the business to exit from day one, but there's a bit of a different reality most of the time. So assuming 2 to 3 years, like what would you tell them? Mike, do you want to lead with that?
Sure. 2 to 3 years is often the time frame that's named. 3 years in particular, because that's the time frame that most funders are going to want to look at, right? They're going to want to look at a 3-year average. And so what we have to keep in mind is that, I'm sorry, I'm flashing through several owners that I had this conversation with, where you have to recognize that you need to create a certain picture that then repeats for 3 years if you want to exit from that picture. And the problem is that making the changes that create that picture can take time as well. So now our 3-year time frame is turned into a 5-year time frame, and the amount of change that needs to happen in the business is a big dictator of the time frame, but it also translates into the change that needs to happen with the owner. And what do I mean by that? I know everyone on the panel has dealt with an owner who's a idea person. I want to try this next and this next and this next. And you take that owner and you put them into an exit framework, and they have to come to the realization that they might have to execute on fewer ideas so that they can actually give the ideas that they've created and executed on time to create a return. So 2 to 3 years, at least, for me, is a time frame to start with. But again, that implies that you can plan this. And the truth for me is that I'd much rather be exit ready than have an exit plan.
Ryan?
Ryan, I can see you itching to add. You're itching to add to that.
Yeah, I'm nuanced with this because I don't, I'm a repeat. The word exit, I think, is a false choice. And like, if we take the red pill in the Matrix, we step outside of that. And like, what are we trying to accomplish? Is it your job or your asset? Because like when someone says, I want to exit, after doing 55 Vistage workshops, I won't even answer the question anymore because people don't actually know. Are you talking about your job and your W-2 income? Or are you talking about your distributions and your equity and your asset? Because if we step outside and we say, okay, well, you could do an ESOP and you could get some of your money up front, all your money up front, you could actually keep your job, or you could like sell to a third party. I mean, like, there's so many vectors on this decision tree. And back to your point, Mike, I mean, my old company 5 years ago was called Growth and Exit Planning Collaborative, and no one wanted to, like, it was such a challenge. And after stepping back and saying, like, the fact of the matter that people listening in own a company and they wake up and spend their time doing something that they don't know how it impacts value is insane to me. I had a $20 million copier business, spending my time eating crap every day, knowing no idea what the value of it was. That so, like, the way I like to think about it is, in Candice, and I was going to ask you, because and I'm excited to have you on the podcast, because you had an understanding of business valuation. So you had a framework for understanding the trade-offs of how to spend your time. Take distributions, reinvest. How can we make that decision unless we know what the value creation trade-off is? And so if we wake up every day understanding how valuations work and the discounted cash flow, the 4 KPIs, normalized EBITDA, the multiple net debt and working capital, then there's a strategic sale. Like, my dad and I sold our family business for 8 figures in 2 weeks. But I fired 60 employees, paid 50% in taxes. I went home and I cried. So, like, you can shorten up that timeline, but you're going to have trade-offs. And the world is a series of trade-offs. So it's what do you want?
I'm sorry to interrupt. Can I push on you a second? I don't disagree with anything you're saying, but my challenge to you would be, are you talking to 2% of the audience or 98% of the audience? I looked this morning, less than 9% of small businesses make over $1 million in revenue. So we can talk about these ideas and these formulas and that sort of thing, and I think it's real, But for the 91% of business owners that have less than $1 million in revenue, we're talking about the basics, right? I translate that for me for that 91%.
Well, that would be a way better question for Graham and Kyle, saying, who the hell are we talking to right now? Sorry, guys. I mean, like, because if we're talking to the people that are underneath $1 million, my guess is Luke is only going to lend them 50 grand, and they should probably go get an Amex card to finance their growth. And
but they're the entirety of the market, right? That is the market.
So I mean, I think isn't this a question for Graham and Kyle? Going, who are we talking to now?
Yeah, I mean, I think it's a great question. I mean, what do you ask a question with a question? And I think the market spans, and that is the danger. You know, we talk about these things like lower middle market or lower market and all of those sorts of things. Even a range of $1 to $50 million. I mean, that's a broad range. I think the principles apply across both, but how that gets applied in practice, I think, is very different. And I think, you know, I just want to dwell on this for a second. I think having somebody in your corner who understands these things is absolutely critical. You know, so, you know, if you want to think about this, if you've got a $50 million business, going to an advisor or a growth coach, whatever, who's dealing with $1 million businesses, they might talk the same themes, but it's not going to be relevant to you. So I think that's really important is, you know, if you're a business owner listening in, is make sure you have someone in your corner, the right advisor, but also who understands your nuance of your type business. You know, Mike, I know you work with a lot of the sort of smaller is not necessarily a bad thing business, but what you do in $1 million business versus a $20 million business could be fundamentally different. And I know there are these kind of
it
these
will
gates.
be, Graham, right? It
Yeah.
will be. And again, I'm unapologetically small business. And so all of these things we're talking about are real, but they apply to such a small sliver of the business owner market. And to my earlier comment, what I worry about is that if we don't clarify that, if we don't call out that reality, what happens is the entirety of the market, the 95% go away thinking something that doesn't apply to them.
But
Yeah,
I think
that's a great call out, Mike.
Well, it is, but like, I think this is why I think there's so many nuances, because like underneath $1 million, I mean, I bootstrapped a company from zero to a couple $1 million. Like, you're eating shit and you're applying all of the money back into the business. And I'm not thinking about the exit, because I'm like, I would like to have a paycheck for my daughter's daycare that's $3,500 a month. So the reality is, like, underneath $1 million, it's a job. And the question is, like,
But Ryan, that's where most exits take place. That's where most small business sales take place. The vast majority are in that space.
Yeah,
I'm
Guys,
tracking you, but yeah, go ahead.
I'm gonna call this part of the conversation. Yeah, and I know it's probably a separate webinar in its own discussion. And I think, you know, I want to recognize, Mike, I think it's a great call out, and I think you guys both have a, you know, there's merit in what you're saying, and I think let's segue into a different part of the conversation. We've got about 10 minutes left, and there's a couple of questions I want to ask you. One of the things, and maybe this is to start with Luke, is we've seen this sort of like buzzword around AI and tech adoption and all of that sort of stuff. And, you know, we'd be remiss not to kind of address it here, but how are you seeing this impact on, let's call it, the deal environment? Okay. And again, maybe it's different on the really small businesses. How are you seeing AI and that impact on how banks are thinking about underwriting and doing due diligence and all of those sorts of things? So Luke, maybe you can lead, and Candice, I don't know if you want to jump in with a couple of thoughts on that.
Yeah, thank you. And I will say that it's a very buzzy word right now. Everybody's talking about it. I don't know that everybody's practicing, you know, the due diligence piece. They're not utilizing it as much as they could. From somebody that uses AI heavily, and my bank is very. We talk about it. We have a strong policy around it. We use it in a lot of the right ways, and I have a lot of exploratory conversations around it. There's a lot of banks and others that aren't, but primarily when it comes to risk evaluation, you know, shadow AI is a real problem, a real risk out there. And if there's not discussions around it, if there's not policies around it, it will impact you know, these companies, and likely in a negative way if it's not that they have to be utilizing it. It's that they have to be protecting against the risks that are out there as well. So as much as I'm a proponent of things that doors that can open and ways to utilize it uh, amongst creativity and data analysis and other areas, I do think the shadow AI is a real topic that I don't know if it's talked about enough, but it will be a hot topic. It will be strong part of due diligence going forward. And if the bank is not asking about it, they're not doing their job, in my opinion.
Well, maybe,
Excuse
yeah,
me.
sorry, yeah.
Oh, Kyle, did you want to go?
Yeah, go for it.
Sorry. Oh, I was gonna say, I'll be quick. I was gonna say, I completely agree with that. I have had more conversations with owners from a almost like a tech enablement slash AI enablement perspective. I think there's so many, to our points earlier about content and kind of what people hear and how people, kind of post about topics publicly. I'm not sure that I'm aware of any company that has been able to, or any owner who has been able to, completely replace. We were talking about like the operations processes that need to be in place, et cetera. Like they have not been able to completely replace humans, in the way that maybe AI is kind of talked about from a content perspective. But the enablement with AI and them being able to be more effective and efficient is definitely clear. And I think it's something that from a buyer perspective, you kind of have your hat on to say, like, is this a process that I can enable in the company kind of post close?
Yeah.
Cool. Maybe just to make things interesting, if we were having this conversation a year from now, maybe from everybody's perspective, if you were to give a short forecast on deal flow, valuations, lending, and any potential surprises for 2026, what would we say? Candice, do you want to kick off and then maybe go Luke, Ryan, Mike?
Ooh, I get to go first. So I think my prediction would be that maybe a little bit broader, Kyle, than your question, but my prediction would be that there will continue to be more potential buyers in the market. There will continue to be more appetite for creating, kind of situations with kind of cash flow stability for buyers in a way that kind of creates portfolios. I think about kind of small business ownership from a couple different perspectives. And I know we're not going to bring the topic of sub 1 million back, but putting together portfolios of sub 1 million type assets, given their abundance in the market today, seems to be a portfolio strategy that could be really interesting. I think we'll start to see play out.
Hey, Mike?
Sure.
Do you want to go next?
Yep. What comes to mind for me about a year from now is that a year from now, it will be as easy to sell a good business as it's usually been. And again, I'm beating that drum, but if you're an owner, small, big, in between, focus on your business, focus on the basics, and you'll find the marketplace a year from now serves your interests well.
Yeah, from my side of things, I'll jump in here and talk. I know I went a little heavy on the macro side earlier, but I think it was relevant to the conversation. And but I will say that banks are still currently right-sizing their own balance sheets, and with that, improved liquidity position could mean a more competitive environment from a lending standpoint. I mean, when we were talking SMB, I'm not an SBA lender by any means. I have a great SBA team choice that I work with, but the alternative size standards I know have increased with the recent change. They're now going to a maximum tangible net worth of 20 million and a net income of 6.5 million, which could open up, historically about 2 million in EBITDA and less is really an SBA deal. Conventional financing for banks doesn't kick in until maybe arguably 4 But truly that could open up some more opportunities on the SBA side. So it'll be interesting enough over the next year to see what that does, as well as, again, improved bank balance sheets. It's going to make more competitive deal structures out there. So with that, I would just add that I've seen more clients right now that are actively looking to buy businesses than I ever have. I'm calculating firepower analysis, structures for multiple clients just to make sure they are ready and positioned to jump on the first opportunity that comes their way. And that's something I've seen more in the last 6 months to a year than ever in my career.
Ryan, you'll have the last word.
I'll just echo what everybody said. What Mike said, Candice said, Luke said. I mean, the thing that will be more and more a thing between now and 2030 as the demographic cliff is coming at us, if you have a good business that you can show and prove future cash flow, you'll get the lending, you'll attract the deals. I mean, if there's 10 houses on the market on your street, you want to have the best looking house. And it's also the most fun to live in too. So I think, hopefully that also gives us some peace of mind to say, like, if you focus on the basics and you don't have time to focus on AI, the macro and all that stuff, if you just focus on building a good business, you'll have as many choices as you possibly want and you'll be the best house on the street.
Yeah, I love that. I mean, maybe just to, before we go into some comments and question and answers, I think there's a few key things that have come through. We spoke about that at the beginning of the show is focus on the things that you can control. You can't control the macros. You can't control all those things. What can you control? You can control cash flow to an extent. You can control how you look at your business and the lens that you look at the business through. I mean, there's a bit of a subtext here. A lot of this is about the emotional state of the business owner. Don't leave it until you're completely burnt out before you start making these changes. And kind of where this is looping back to is, if you look at the state of the market, is in the VC world, the focus has moved from free cash to profitability. It's no different in the SMB space. It's around, have you got a good business that runs when you're away on vacation, that produces cash flows? And these are basics. And I don't think that changes whether you're $1 million business or a $20 million business. You may be the scale of that. And it's keeping. There's a comment that's come through here. I love the comment, doing the boring stuff really well. I mean, if there's one takeout that I have around this, is those businesses that are doing the boring stuff really well, those are the ones that are succeeding. They're creating the optionality to sell or exit or stick around and run it from the boardroom, so to speak. I want to maybe flag a couple of the comments that have come through and maybe just get a view. Ryan, maybe to you, there's somebody's commented here that said they're using the term end game rather than exit. What do you guys think about that, Mike? I mean, as I say, exit's in the name of your business. I mean, end game is quite a cool way of thinking about it. So what's your thought?
Yeah, I mean, I don't love the term, because it implies I'm leaving. I'm going to do something else. I'm done. And that, to your point, that's the emotional part of this for the owner. Ownability, sellability, they're the same thing.
Optionality, yeah. And there's another comment here. I did a job for an $80 million firm and discovered there was no budget process. The owner told me the CFO was not ready to build budgets. I'm going to throw that at you. I'm going to throw that at you, Ryan, and then maybe Candice, you've got a thought on that.
I mean, so back to, like, what do I know? It's like my favorite quote from Shoe Dog with Phil Knight. What I do know is, over the last 4 years, I've had around 3,000 owner operators between 5 million and 500 million go through my workshops I've specifically talked to. 10 have a 3-statement forecast about that. And what I mean by 3-statement forecast is you mathematically tie together your income statement, your balance sheet, and your cash flow statement. So in the future, you can see your cash, not your net income, not your gross profit. Everyone's freaking guessing, you guys. I mean, I had $1 billion company in the Vistage workshop, and I'm like, so like, think about this. It's like, it's truly insane. And again, we're not here to do this, but like 2008, 0% financing, everybody did balance sheet refinancing for 15 years with free money. And now the game is inverted. So now people care about cash. And like, so I said to this guy, I'm like, he's building a $20 million plant in Missouri. I was like, do you have any idea what your payables, receivables, inventory, taxes, or distributions will be at the end of 26? And he's like, nope. I'm like, you're freaking guessing. How does that feel? And so it goes back to, Mike and I's conversation, like, build an asset, know how valuations work and know what you're doing, quit guessing. And if people are willing to, whether it's $1 million or 100 million or $1 billion, you're still guessing if you can't see into the future.
Yeah,
Candice?
Ryan and I have had this debate before, and it is kind of concerning, but then also just I think that we've made the as an industry, we've made the concepts around forecasting and how do you calculate cash flow and the terms that we use and the definitions around those terms so complex to some degree, even though they're very simplistic at their base, that I think people outsource finance. They just kind of don't. Business owners outsource finance, and they just kind of, I have a bookkeeper and I have, kind of the set of people, advisors around me to be able to answer the basic questions, and they don't kind of dig in further because it appears to be such a complex topic. And so from my perspective, it's kind of demystifying that and just kind of making it is as simple as, how much money do you make? How much are you spending? And what does it need to be spent on? And it's like literally just that simple.
Absolutely, I absolutely love that, Candice. I mean, like, no disrespect to any of the investment bank. It's not about trying to sound like the smartest person in the room. It's about engaging with business owners in a language they understand. There's nothing actually complex. It's simple concepts, and it's about doing those things repeatedly and doing them well. And I think that's a key takeout for me. We're going to wrap up, and I'm going to give each of our guests, we've got 3 minutes left, so literally a 20-second closeout sign bite. And I'm going to start with you, Luke, Ryan, Mike, and Candice to end. Just the last takeout in terms of the discussion today.
Yeah, I guess just to wrap things up, what banks are looking for is exactly what was just described by Ryan. Is we're looking to understand exactly what a business owner is trying to understand. That's why banks ask a lot of stupid questions, in my opinion, but because it is basic fundamentals. Banking is not complex as a whole because we're looking to understand exactly what Candice just said. And that's how we do it, is through communication. And if I can educate business owners on how banks operate, then I feel like I'm doing my job. So thank you for having me on.
Fantastic. Thanks, Luke. Ryan, closing thought.
It's the basics, like Candice just said. I mean, like, from my own perspective, and I think there's a very good analogy of the moment that I realized that in the US, doctors are insurance salespeople, and that I had to be responsible for my own health and understanding how to do it. It's really not that complicated. Get good sleep, work out, eat well. Business is the same, just like Candice said. And using your gut, and then and owning the understanding. That's one thing that we can do as business owners, is own how this works. So that way you can have conversations with the advisors and be a little bit more productive, because you're still going to need other people, but you're owning that education and understanding. Can't outsource
Fantastic.
that, to Candice's point.
Awesome. Thanks, Ryan. Mike, your closing thoughts.
Yeah, I'll absolutely echo what Ryan just said. And I translate it this way for small business owners. Right now, set a recurring appointment in your calendar for one lunch hour a month to commit to this topic. Watch a podcast, listen to a story, read an article, whatever it is. Start learning, stop waiting, commit to starting to familiarize yourself with this topic. The payoff, the return on investment is massive. Stop waiting, start now.
Fantastic. Thank you, Mike. And Candice, we'll leave it to the rose amongst the thorns to end off.
I was going to kind of take the perspective. I completely agree with everything, all the wrap up comments. I was going to take the perspective of take a deep breath, preserve your energy. There's so many things kind of happening all at the same time, but there are definitely things that can be addressed and kind of be tackled and kind of be planned for. So I completely agree with Mike's point. Pick a topic, go deep in your topic for a period of time, and just, you know, you can do this.
Fantastic. Well, listen, thank you to everyone, to our panelists. We really appreciate you today. And, you know, if anyone wants to reach out to you, you're all on LinkedIn, so easily connectable. To everyone who's dialed in or is listening to a recording, thank you for taking the time. And if you've got any questions or you want to review the report, scan the QR code or go to our website, www.bizvalglobal.com, and it's available for download. But we hope you enjoyed today's session, and we hope to see you soon. Thank you, everyone.